This is a lecture from Open Tuition. For the free lecture notes that go with this podcast, please visit opentuition.com.
This is the last session in Chapter 7, the weighted average cost of capital. Now, in previous sessions, we've looked at how to calculate the cost of equity. In the second one, we then looked at how to calculate the cost of debt. But of course, most companies are financed partly from equity, partly from debt. And so, in this section, we're going to look at how to work out the overall cost of capital, or the weighted average cost of capital. And it is, in fact, precisely what it says. We're going to work out individually the cost of equity finance for the company, the cost of debt finance, the weighted average. We will simply take an average of the two. Let me show you what I mean. Looking first of all at example 9 on page 27, which is a relatively tiny one. But this will illustrate the approach, and then you can have a go yourself at example 10. So example 9. JPLC is financed as follows. Part of the finance comes from equity, the $5 million shares. We'll read the rest of the information later. But they've also got debt finance. There's 4 million, 8% debentures. What we're asked to do, part A, to calculate the return to investors on equity and on debt. More importantly, part B, we're going to calculate the weighted average cost of capital. And so let's do it. First of all, part A, let's work out separately the returns to investors, KE and KD, the returns to investors on equity and debt, for this example. So first of all, let's look at equity. Remember, KE, the investor's required return, we've got the formula, so it's D0 times 1 plus G over P0 plus G. Well, this one is in fact quite easy, apart from one little trick. First of all, the dividend, it says with $5 million $1 shares quoted at $2.50, on which a constant dividend of 32 cents per share is about to be paid. So surely if it's a constant dividend, not only is the current dividend D0 32 cents, but G, the rate of growth, of course, is 0. The one tiny trick, though, the share price, it says, is $2.50 cum div. However, if it's cum div, you should remember from earlier studies that that's the price assuming a dividend is about to be paid. And it says later there's a dividend of 32 cents about to be paid. And so the $2.50 that shareholders would be paying, 32 cents of it is for this immediate dividend. What you might call the true value of the share, or the ex-div value, is 32 cents less. Now P0 is in fact the ex-div market value. Well, again, in cents it's 250 at the moment, but that includes the right to a dividend of 32 cents that's about to be paid, and so the ex-div value is 218. And now, of course, it's easy. There's no growth, so KE, 32 divided by 218 is equal to 14.68%. So that's the return that shareholders require. But similarly, we're asked to calculate the return to investors on debt, or KD. And here again, it is a nice easy one. It says debt, there's $4 million of debt, 8% debentures, quoted at 92. There's no mention of any repayment date, in which case we would assume that the debt is irredeemable. So with irredeemable debt, it's simply the interest divided by the market value. Here on $100 nominal, the interest to be $8 a year, the market value 92, and therefore the return to debt lenders is 8.7%. And in fact, of course, we're not surprised it's lower than the return to equity. It's the shareholders carry more risk, the risk that the dividends might change in the future, whereas debt, of course, in an ideal world would carry zero risk. They're guaranteed $8 a year. In the real world, there is some risk the company may go bankrupt. But because the risk is much lower for debt lenders, we're not surprised that they're happy with a much lower return. However, those are the returns to the investors. Much more importantly, though, we want the cost to the company. And so first of all, let's look at the cost of each source of finance separately. First of all, the cost of equity. Well, as we discussed in a previous session, the cost of equity is always equal to KE, the shareholders' required return, which here we've already calculated is 14.68. The cost of debt, however, remember, although the investors here are wanting 8.7, the company therefore will pay 8.7, but the company gets tax relief on the interest. The cost of the company will be lower. And we looked in the previous session, two ways we can get it. Either take the after-tax interest as a percentage of the market value, or, since we have already worked out the return to investors KD, multiply by 1 minus the tax rate to get the after-tax cost. So KD is 8.7. The tax rate 30% 0.3, so the cost of the company 0.7, and therefore the cost of debt 6.09%. Now, two things. Remember, here it's very easy because it's irredeemable. Remember, had it been redeemable, we'd have had to work out an internal rate of return. Secondly, remember, it's very unlikely indeed that you'd be asked to work out the return to investors. Normally, you'll be going straight to part B. Cost of equity is KE, cost of debt, after-tax interest on market value if it's irredeemable, internal rates of return if it's redeemable. However, that's nothing new. We'd done that before. But this company, part of its money is being borrowed at 14.68% from shareholders, part's being borrowed at 6.09% from debt lenders. We want the average cost. And so we do simply take a weighted average. But importantly, we'll weight the costs. Let me just write down the costs. Individually, the cost of equity 14.68. The cost of debt 6.09. But the weighting we'll use, it's the ex-div market values of each type of borrowing. It's easy, but check me, be clear what I mean. The first of all, equity. With 5 million shares in issue, the market value, when it's 250 cum div, but we said earlier 32 cents of that represents the dividend they're about to receive, and so the ex-div value, 250 less 32 cents, is $2.18. So the total market value of the equity borrowing, check me, but I think is 10.9 million. Similarly, the debt borrowing, There's 4 million debentures, well that's the nominal value. The market value, it's quoted at 92. Remember, that's 92 for every 100 nominal. And so, the market value of the debt finance is 3.68 million. So the total market value of the company is 14.58 million. But again, part of it's been borrowed from equity at 14%, part from debt at 6%. We take a weighted average based on those figures. So the weighted average cost of capital here, equity is 10.9 million out of a total of 14.58 million, and the cost is 14.68%. Debt comprises 3.68 million out of a total of 14.58, and the cost of that is 6.09. And so now just a relatively simple calculator exercise. The weighted average cost of capital comes to 12.51%, subject perhaps to a tiny bit of rounding, but any rounding here is irrelevant. But that's the weighted average cost of capital. The extra work involved, of course, I hope you agree, is tiny. We've dealt with cost of equity, cost of debt before. You must be able to do them. The weighted average, simply weight the individual costs by the ex-div market values. So there we are. Well, that was example 9. That was a quick one. Make it a bit more interesting. Can you have a go at example 10, please, on page 28? Have a go. As always, pause this recording, have a go at example 10, and then come back and check. Okay, well, let's look at example 10. Here, all that's required is the weighted average cost. And so, look at the two bits individually. First of all, the cost of equity. The cost of equity, remember, it's always the shareholders' required return KE, which we get straight from the formula. D naught 1 plus G over P naught plus G. What is it here? Well, there are $10 million shares. Dollar, remember, is the nominal value. The current dividend is 20 cents. Dividends, next line, are growing at 8%, so G is 0.08. Divide by the ex-div market value, which is 320, plus the rate of growth, 0.08. So the cost of equity is 0.1475, or 14.75%. Separately, the cost of debt. Now here, a little bit messier, because with 6 million 10% debentures quoted at 105, however, they're redeemable in 6 years. So again, if you think back, if it's redeemable debt, we've no choice but to set up effectively the repayment schedule and work out the internal rate of return. So let's do that, and always do it for ease on $100 nominal. On $100 nominal, the cost now, the market value, is how much? They quoted at 105, so it would be $105. There's interest payable each year. Well, the interest itself, the coupon rate is 10%, so the interest would be $10 a year on $100 nominal. Company gets tax relief here at 30%. So the interest each year, the cost of the company, $7. They're redeemable in 6 years, so it'll be $7 a year from years 1 to 6. Finally, in 6 years' time, there's a repayment or redemption. They're redeemable at a premium of 10%. Again, the 10% premium is on nominal value. So 100 nominal plus 10%, 110. And that's not tax allowable. The cost of debt will be the internal rate of return. So 2 guesses. I would always guess myself at 10% first. And depending on the answer, do a second guess. Well, at 10%, 105 is 105. The discount factor, the 6-year annuity at 10%, the factor is 4.355, giving a present value of 30.49. The repayment in 6 years, so the ordinary discount factor for 6 years at 10% is 0.564. 62.04, giving a net present value of I think 12.47 negative. Well, we want an NPV of 0. It's negative at 10%. To get 0, it must be somewhat less than 10%. So I'll make a second guess at 5. Well, again, the 6-year annuity, this time at 5%, is 4.917. The ordinary factor 6 years at 5% is 0.746. Giving present values 34.42, 82.06. Plus 11.48. The internal rate of return must be in between the two, so the cost of debt the internal rate of return. I said before, use the formula if you remember it, do it the way I did before, it'll give the same answer. But here, in fact, it's 5% plus 11.48 divided by 11.48 plus 12.47 times 5%. Which is 7.4%. Now, if that bit was too fast for you because you've forgotten your internal rate of return, go back to the previous session, check you are happy with it, and then repeat the calculation here slowly and check you do get the same answer. However, although it's taken a bit longer than the last one, we know the cost of equity, 14.75. We know the cost of debt to the company is 7.4. The weighted average, we'll weight by the market values. So what are the market values in total of equity and debt? Equity, there are 10 million shares quoted at 320, so the total value is 32 million. Debt, 6 million. The nominal value quoted at 105 per 100. And so the market value of the debt finance is what? I should be able to do this in my head, but 6.3 million. So total market value is 38.3. We'll weight the costs by those market values. The individual costs, again, equity we calculated at 14.75, debt 7.4. Well, weight them by the market values. Equity is 32 out of a total of 38.3. Debt is 6.3 out of that total. And so multiply and add. And there we are. There is the weighted average cost of capital. 13.54%. Now you'll see at the bottom of the page that very often that in fact is the appraisal rate we'll use for a project. If this company was considering investing in a new project, we could set up the cash flows discount, which you've all done before, but the discounting would be at 13.54%. The reason I say could be is you'll see in later chapters that for certain reasons we may end up needing to discount at a different rate rather, but we'll discuss that separately. One final point I must make is slightly annoying, but if you look at the formula sheet, which in the notes is on page I think it is, the beginning of the notes anyway. The formula sheet that you're given in the exam, you will see it gives a formula for the weighted average cost of capital. And if you look at the formula that the way he presents it, it says the weighted average cost of capital is VE over VE plus VD times KE plus VD over VE plus VD times KD times 1 minus T. Now there is one little problem with that. VE, VD, no problem. VE and VD are the market values of equity and debt. And so no problem. We are weighting by the market values. In our example, it was 32, 6.3. KE is the return to shareholders. Well, of course, I've said several times, the return to shareholders, it will equal the cost of equity. And so no problem. In our example, it was 14.75. The problem, though, is here. That for the weighted average, we should be weighting by the cost of equity, the cost of debt. However, the cost of debt is only equal to KD times 1 minus T if it's irredeemable. And so this is somewhat misleading. Personally, I don't think you actually need to look at the formula sheet anyway, because although the cost of equity, cost of debt might take time, the weighted average itself is very, very easy. However, more importantly, remember that the formula itself is only true if the debt's irredeemable. If it was redeemable debt, well, this bit should be the internal rate of return.